Welcome to Unaccountable, the world's okayest accounting game show for product news, updates, and education. I am your credit crusader of a host, Tyler Otto, and I'm joined by the debit dynamo that is Jeremy Van Groll. Hello to you, sir.
Hello, sir, and happy holidays since we're between them in this recording, and it looks like you have a little bit of a different background today. What's going on?
You know, we're recording from the in-laws' basement, right? Isn't that the beauty of having a biz like this, is you can pick up and leave town and work wherever? So instead of, pulling 10-hour days at home, I'm pulling 10 hours here. It's great.
Do the in-laws know you have this podcast, and are they fans?
You know what's going to be really great is when they come down the stairs into the basement, don't realize I'm recording while like shuffling through a box behind me, and we're just going to let it roll.
I don't want to say your wife. I don't know if I should say your wife's real name, but let's pretend her name was Catherine.
Okay.
Catherine, I'm pretty sure Tyler's downstairs doing a male version of OnlyFans.
If they can reference OnlyFans, I'm already disturbed.
I love it. All right.
Jeremy, it has been a surprisingly not quiet week. Double negative there. Everyone loves a good double negative. There's actually been updates this week, which is kind of fun. So I think this week we got to start out with in the news.
Let's do it.
So first off, I don't know if you've seen this article that just came out, but the IRS has disallowed 20,000 ERC claims. Now, first time I read this, I'm like, oh goodness, like this is kind of scary. What are they just willy-nilly? I always wanted to throw in willy-nilly into a sentence, first of all. But second, right. Willy-nilly, what are they just going through and denying? And at first it seems scary, and then you realize this is a very small sub-portion of all the ERC claims submitted. And did you see the criteria they used to eliminate all of these?
I did not, because I saw this article too, but it didn't include that criteria. And I was really curious. It's got to be, to me, I have to think it's something relatively obvious that they could quickly have interns or some kind of computer program say this absolutely makes no sense, denied.
Yes. No, you absolutely hit the nail on the head. First off, it is entities that did not what in 2020 or 2021?
Did they not file their 941s or their quarterly tax filings?
Even more simpler than this.
Oh, that did not. I have no idea. Like, registered appropriately? I have no idea.
Businesses that did not exist in 2021.
Yeah, that's a pretty easy one. You want to cut those out right away. Like, way to go, IRS. That's fantastic.
Yes. And then the second criteria they use, Jeremy, here's your question. Second, Jeremy, they also are automatically denying all of those employees that had exactly how much paid in employee wages?
$0.
Easy as that, which I feel like, okay, IRS, you really did pick the low-hanging fruit here. If the business didn't exist or had zero in payroll wages, you're probably safe, which just kills me then that there's 20,000 returns submitted and the people had the guts or the confidence the IRS wouldn't even catch these to request funds.
And do you think this is like, so there's so many of these mills that we talked about before that are just hammering these out and like sending us messages on like, hey, we'll do your ERC stuff. Is this firms doing it, or is it like just shady people coming up with employees and businesses that I'm just going to put this out there? Or
I don't know if there's 20,000 business owners out there that are smart enough to think like, oh, I'm just going to go say I had employees when I did it. I bet there's a mill that's happily collecting fees saying, you qualify, we'll get you. Now, what I don't get is, they're probably advertising 26,000 an employee, but when someone had no employees, how are they coming up with this number?
Yeah, I don't know. But again, I'm very critical of the IRS typically. Kudos to them for doing this initial screen.
In the same vein, the IRS did give us one piece of good news. Jeremy, the IRS has announced that for those people that errantly filed and voluntarily give back the funds, they will only require them pay back what percentage of what they took from the ERC?
I read this one too. So they have to pay back 80% of it, and they get to keep 20%. Yeah,
exactly. Which, a good carrot, right?
Yeah, I agree. But then again, a very brief article I read on this, it didn't make it clear to me, like, do they need to willingly do this, or if they get caught and they say, you have to pay it back, in both of those cases, do they get to keep the 20%, or do they have to proactively do this to keep the 20%?
So it's called the voluntary disclosure program. So at my
Yeah.
understanding of this is you can either ask for forgiveness right now and get to keep 20% of it if you know that you were bogus, or you're going to be paying back all of it plus maybe penalties and
Yeah.
fines.
Yeah.
So, this is your get out of jail free card and then some for those of you that may have a client that knowingly did this. Like if you're ever wondering if your client was towing that line, this might be the moment you go back to them and say, hey, just so you know, we probably should voluntarily take this back, but good news, you get to keep 20%. Your client will probably be happy with you for being able to identify that they can keep a small portion of it. So, and brilliant by the IRS, because who's going to voluntarily give back 100%? But if you tell them they can keep a little, it's kind of smart.
Oh yeah, I agree. And that's exactly where I was going to go with this, is like, if you have a client that has it and you didn't do it, I would go to them right away and be like, hey, do you know? And say the same thing that you did. Because first of all, like, they probably don't know because they're nerds like us looking at IRS news articles all the time. But yeah, just providing that value.
I love it.
Cool. Well, I think great update there. And I think with that, we can get into our first segment. And
Ooh.
this is a repeat of another one, but I took a little bit of a spin on it. So our segment here is called Within Reason. And if you
Okay, I
recall,
recall this.
yeah, so the example I gave you is there are words hidden in other words that have accounting reference most of the time. I think all the time. I don't even think I went off the rails this time. Man, I don't know how that happened. I must have been off my game. But so an example would have been a draw at a sporting event found within your name.
A tie, Lorado.
Yeah, or Ty Tyler, right? And that's how I changed it a little bit. The first word is going to be separate, but in the after part of it, all accounting terms. Are you ready?
I'm just surprised you didn't go off the rails with this one. I mean, who took Jeremy to the discipline tree for a snack?
You wait till we get to fast figures. I will totally redeem myself. All good. All right. First one is a state of matter found within the practice of combining many sets of books into one.
State of matter. Consolidating gassets?
No, but I liked it. Consolidate. A solid consolidation.
Oh,
So the first
consolidation. Okay.
word is inside somewhere that follows it.
All
A
right, all
solid
right.
consolidation.
What's the ruling?
I like you went to get. I'm going to say no on that one. You pulled you do it the wrong state of matter. Oh, all good. All right, number two. A shortened name for a delicious tequila-based drink found within the net sales less cost of goods sold.
Gross sales minus cost of goods sold or net sales minus cost of goods sold?
Net. Like you would typically have gross sales, then returns or whatnot, then net sales, right? Then
Yeah.
cost of goods sold. Your number after that is
Are you going for like a margarita here, like a mar, like a gross margin?
a marg gross margin.
Okay.
All right, yeah, I'm gonna give you that one. That was pretty good. All right, we'll dumb it down a little bit on this next one. Okay, common writing utensil found within a general term for a business's cost.
X pen says?
Yeah, pen expenses. Yeah, perfect. Next one, a plaster-based medical restraint found within a tool used to estimate a future financial result.
A forecast?
Forecast or cast forecast. Yeah,
I'll take it.
I get. All right, doing well. Last one. This
Jeremy,
one's-
are you forecasting for the majority of your clients, cash forecasting?
We are not. I would say probably only 10 to 15%. But I know Reach came out with their tool to do this a lot easier. And I have our operations manager. I said that is one of your top two priorities is dig into that. Because I feel like just throwing it out there for our clients that are paying us hefty fees already or adding it to as another option on the ones that are paying smaller amounts will pay off some dividends.
It's pretty friggin' fantastic because you can go in, make modifications on the P&L or even driver assumptions and see that whole thing flow through to the balance sheet and then a cash forecast. It's kind of amazing. So you knew why I asked because we've been playing with this tool to add it for our fractional CFO clients and it's been stellar.
Yeah, we'll have to talk sometime. Like if you get this down, we get it down. What do you think is the right cost for clients for this added service? Because like this is a big one, right? Like if I'm a board member for ours, because we do nonprofits, I want to see cash forecast all day long, right? Like what are you going to need? I can change investment decisions. I can do a whole bunch of stuff with that information.
So to be honest, on my side, so we're getting into a pricing conversation. I've hijacked your game here, but I throw the things I don't want to do for all my bookkeeping clients. On my proposal, there's fractional CFO services, which they have not elected. It's not automatically selected, and it is a hefty price tag. And under Frac CFO service, it has budget creation, forecasting, wage analysis, data planning, reasonable compensation reports, all these things where if they ever come back to me and say, well, you're my bookkeeper, you should do this, and it'll be like very clearly no. In the contract, it said this was Frac CFO services and you declined it. So I now have a big price tag, but then the few clients that are doing Frac CFO, we get a pretty penny for it.
I like that you're calling that out because that's a great conversation to be able to challenge them back. Is there a portion of Tyler's soul? Is that included in Frac CFO?
Oh, well, the soul's already gone. We're now just on to mental stability left, but that also is disappearing quickly.
That's right. The clock is ticking for sure.
Yeah. Get yours while you can, because it's dwindling. Sorry, proceed, sir.
No, last one. All good. All right. An adjective meaning morally right and fair found within an entry in a company's general ledger that occurs at the end of an accounting period to record any unrecognized income or expenses. A lot in that one.
Yeah, there is. Like I first heard goodwill. Oh, goodwill in kind?
No. Adjective for being morally right. So if I am morally right, I am.
You're not Jeremy then.
No, you are not. No, that is the opposite. The antithesis.
In kind donation, goodwill. I'm gonna go with platypus.
Buzzer.
Oh, sorry. Hold on.
Adjusting entry.
Oh.
So I have a question for you.
Yeah.
So like QuickBooks has that little button where you can click if it's an adjusting entry or not, right?
Yeah.
Do you use that to discern between things, and if so, when and why?
I thought that button was just a joke button that didn't do much.
Oh no. So you don't use it?
Yes, we use it on anything when we're doing taxes for the clients, or we get adjusting entries from the tax preparer if we're not doing the taxes. Yes, we use that button. Not very frequently. I feel like QuickBooks and most other software should come up with a 13th accounting period, and it's just like an extra day at the end of all the months where you can do the adjusting entries. So you could run a report for the whole year on operations, but the 13th month, which is just one day, could be all the adjusting entries. How beautiful would that be?
I love it and hate it at the same time. So we both came from corporate accounting. Did you have that in a previous life? A 13?
There's a couple softwares that do. I can't even remember which one because I just demoed it. I never got to use it daily, but I remember demoing it and thinking, this is brilliant.
I was in an SOP platform and they had that. And that's what, like, good in theory, and it even works well, but just brings me back to nightmare of corporate accounting. And I like to say like 60, 70-hour weeks, but that's like what I'm doing now, but at least it's for me.
There you go. You get the benefits.
Right. Someone was trying to tell me once that like they use accounting or the adjusting entry for anything that's not cash based when they make entries at the end of the month. And to me, it like didn't make any sense. But I'm like we almost all of our clients, because they're nonprofits, get audited. So anything that the auditor would bring back to us or a tax professional, then we'd make that adjusting journal entry. And I know we didn't come up with that, or at least came from a report from their accountant.
Yeah, I'm right there with you. I mean, I think, all technicality, it's the things that change operations, so you can exclude them. But I don't think QuickBooks has mastered this whole difference between managerial accounting, tax accounting, which is what I think it's the bridge it's supposed to try and help cover. That the gap it's help. Hold on. I think it's the gap that QuickBooks is trying to bridge, but I don't think they do it well.
No, I would agree. And I think, like, again, if you compare their price to what like an SAP platform would cost, again, right, that's a huge gap right there too.
Yeah, I mean, I feel like QuickBooks is like, there's bourbons I love, Jeremy, that are $30-$40 a bottle. I've also had a bourbon that was over $1,000 a bottle. I will tell you that $1,000 bourbon did not taste 10 times better than a $100 bottle of bourbon. QuickBooks is the same way, where I can tell you it's not the best, but man, for the price point.
Yeah. And regardless of the cost of that bourbon, I'm just as hungover the next day, right? So it's like, hey, let's go one that
Same
tastes.
ends.
Yeah, that's right. Yeah, look at that. I think you got 3 out of 5. That was pretty good.
You
Nice
know,
work.
I'm gonna happily take that. Ending the
Yeah.
year strong, or starting the year strong by the time this drops.
That's right.
Well, Jeremy, with that noise, it is halftime. And so let's head to the benches and have a quick app snack where we take a bite out of an app. And this week, appropriately, we are going after track 1099. Oh, Jeremy, don't you just get PTSD thinking about it?
Oh, it's coming. 1099s. Ah.
And I will say, like, your sentiment of 1099s is no way reflected upon Track 1099 itself. It's the need for Track 1099. We appreciate softwares like them and Keeper that make it a little bit easier compared to our bottom shelf bourbon QuickBooks product for 1099s. But Jeremy, would you like to introduce them or at least talk the use case here?
Yeah. So yeah, I completely agree with you. Like Track 1099 is a good tool. I believe also, I don't know if it got purchased by Avalara or what, but it's Avalara 1099 now is what I had to
Yep.
go to the website the other day to check out one that we filed last year. But yeah, just does a automatic or an electronic filing of 1099 information both to the vendor that should be receiving the form and to the IRS, and gives you a confirmation on either if it's through the mail, which please don't do that if you can, right? That the letter was received, or if it's from an email, that the email was opened and it has been accepted by the IRS. So it just makes it easier to bring that information together. You can roll over clients from year to year, put the new dollar amounts in there, add, remove vendors as you need to, and like relatively reasonable cost too. I forget what it is this time, but a couple bucks a filing, maybe.
If you're waiting until the last minute, like on January 31st to submit it, it's like $2.50. Like it doubles in price from $1.19 to $2.50. It's so cheap, Jeremy and I didn't even think it was worth looking at the price because it is non-consequential. It's cheaper than if you were to buy the forms from Office Max or Staples and do it yourself. Huge fan.
Yeah, same here. I think I've used it every year as the first one I stumbled upon when I was doing this for the first year, like 5 years ago, and trying to figure it out. That it was easy. I'm like, why? Why would I do something different when this went really well? Also, but like, I don't have our clients connected to their QuickBooks screens. We've typically typed it in there because I felt like we tried that once and it was painful and the information wasn't great. It was just like almost harder.
You and I are in a lot of the same communities online, and the amount of disdain I see around QuickBooks' 1099 process and what you can include, or exclude, or manipulate is just terrible, which then gets me back to beating the keeper drum all day, every day, which that was the feature that brought me over to the dark side. And I've been hearing from Ben and Kenny that they're about to release a feature where you can export their 1099 field directly into both Track 1099 and Text 99 CSV import format. They're going to make it like perfect that you can just export it and it's ready to go into those two softwares. Yeah, so no, I'm a huge fan of it because the other thing too is Track 1099 is not limited to 1099s. We've had to send out a few W-2s for random clients that maybe had a one-off employee they paid outside the system, it's after the year, and then we need to amend the W-3 as well, and you can go in and do that one-off yourself. It's been incredibly valuable just for those random forms where you got to get them out and you don't have any other way. So, and then yeah, rolling over year is super easy in that software. So if anyone's looking for a solution, I would say give it a go because it's easy. It works. It's nothing sexy, but it gets the job done and you're never left complaining.
I feel like that's a good metaphor for us as well.
Well, with that, Jeremy, we are on to our third segment, and we are going to play a game called Mind the Gap. That's right, we're getting into the time of year where, as closing out books, we might want to remind our clients of all the different generally accepted accounting principles that are important to us managing their books. And I honestly feel like a good refresher of these helps us hold them accountable somewhat. So, Jeremy, I am going to read off 6 descriptions of accounting principles, and I want you to identify the name of that generally accepted accounning principle.
I would like to first state for the record that we are not in the business of holding people accountable. Clearly, given the name of the podcast.
It's in the name.
Fantastic.
So, Jeremy, question number 1. This principle requires that businesses recognize revenue when it's earned rather than when payment is received.
This should be the revenue recognition principle.
You are correct. And the reason I love this, so I'm going to give you a real quick story, but I, in my 20s, was once sitting in a job interview to be a director of finance for a nonprofit. And they asked me, do you follow all the generally accepted accounting principles? And I was like, most of them, and they're like, the director was very concerned with me. He's like, what do you mean? Like, and I was like, well, which ones are you talking about? And he said, well, all of them. I'm like, okay, which specific ones? And he goes, I don't know what they are. I just want to know that you follow them. And I feel like so many business owners, this is exactly it. They want you to follow GAAP, but they have no idea what GAAP is. So I love pointing back to this one first and foremost because revenue recognition is the case in point that we should be managing your books on accrual basis. Yes, you can file taxes on cash, but if you want to understand your financials, accrual is one of the main things of GAAP financials.
Yeah, I completely agree with that. And I would like to thank you for giving me a softball on the first one, because there's probably 3 GAAP principles that I actually remember, and that is one of them. So if you have 6, the best I can get here is probably 50%.
Well, we'll see how it goes. Question number 2. This principle assumes that the business is separate from its owners and other businesses.
I'm not going to lie, I have nothing on this one.
Jeremy, this is the business entity principle. And I feel like this one's valuable as well because we want to remind our clients, no, you can't have your personal account linked. No, you can't manage your 3 separate businesses in one set of books. GAAP financials indicate that the set of books assumes that the business is separate from its owners or other businesses. Now, yes, there are a few nuances here where if it's a disregarded entity, you can get away with managing it in all in one set of books. I get it. People do it with their investment properties all the time because they all are disregarded entities of the person filing their taxes. So there are some exceptions, but when my client wants to manage a car wash with a truck repair store and a bed and breakfast all in a set of books, no. And you're not putting your personal car expenses in there as well because you want to put all that stuff on the company card for miles. Separate it all.
Yeah, I completely agree. And I have turned away clients before saying that, hey, we have these 3 businesses, we're using classes and QuickBooks to manage them. Absolutely not. Like the equity section, to try to get that accurate is a huge pain in the butt. If you do it at all, yeah, you can get separate P&Ls and they'll be pretty solid, but your balance sheets are garbage. Unless you spend
especially,
all the time.
Yeah, AP/AR ledger, like getting that broken out correctly too is just, it's a beast. So no, you do not commingle any of those because come tax time, you're going to hate life. Question 3, Jeremy. This principle requires accountants to use the same reporting method procedures across all financial statements.
Consistency principle?
I'm sorry, we were looking for the permanence of method principle. So this means across all different financial statements year over year, clients need to be using the same method to depreciate, the same method for inventory counting, the same method for tax basis. Because if you were to switch, let's say from cash basis to accrual on an invoice that maybe was in December but paid in January, that thing would just disappear into nothingness going from cash to accrual because it doesn't show up in the cash year and it doesn't show up in the accrual year. So you got to stay permanent. Otherwise, you're filing form 3115, I think. Nobody hold my feet to the fire on that. But you've got to change the method. And changing it on depreciation isn't the hardest thing, but changing it for like tax basis, there's a lot to go into it, and I'm scared of doing that. So permanence of method. Make sure your clients don't want to try and come up with some clever idea to just change how their financials managed.
Yeah, agreed. And again, going back to prior life in corporate accounting, I know there have been a couple of quarters and we were a publicly reported entity where things were a little rough and they're like, well, maybe we should relook at our vacation accrual for labor and we can take this to the auditors and they'll be able to sign off on this and we'll just need to file whatever, right? It is something that you need to be consistent or it's garbage, or again, hopefully that auditor, and I was not that CFO level that I got involved with that conversation, but said like, is this reasonable? What are the changes that are going to result because of that? And made that public to stockholders and whatnot.
Yeah, nail on the head, sir. Yeah. Question 4, this principle assumes that the organization will continue to operate its business for the foreseeable future and that every decision in a company is taken with the object in mind of running that business rather than selling or liquidating.
I want to say a solvency principle, but I don't think that's it.
There's a great news outlet in our industry named after this principle.
Oh, I do know this one from audits. You get a going concern. I don't know. I don't know the right language.
There we go. You are correct. The going concern principle, which basically means, folks, we have to manage the financials as if the client is going to continue to operate. You can't start pulling funny tricks like we're going to expense all our assets because we're going to lose our lease next year. No, you need to run the business as if it's going to live on in perpetuity. Otherwise, that's why businesses have to file things like bankruptcy and let everyone know they're liquidating. But there has to be huge disclosures if you're going to manage otherwise. And the liquidation, the failure of the business has to be imminent. So the going concern principle, you need to operate it like it's going to keep on operating, even if you do have plans on the side to sell or liquidate later on.
There's a couple nuggets of that accounting knowledge that I had in college and whatnot, still rolling around up there. That never got into public accounting.
Yeah. I mean, did you get more nuggets of knowledge or nuggets from the dorms?
Ooh, maybe it was a tie. And they were talking pizza nuggets, right? That you'd get at the, right?
Aren't those pizza rolls? I'm going chicken nuggets, man.
Oh, yeah.
Chick-fil-A all day. All right. Question 5. This GAAP principle requires that accountants, business owners, and all other parties involved in financial reporting are honest and truthful.
The golden rule principle. Oh, yeah, this one.
I'm sorry, Jeremy. The golden rule principle, that would just mean we do what they do to us, right? So we give them wrong answers. We tell them, what do you want the number to be? That wouldn't be it.
Never get us statements.
Yeah.
All that.
No, this would be the principle of sincerity, which means that we have to be doing everything honestly and truthfully, which I know we tout our profession as having a high level of ethical standards, yet how many articles do we read and hear of another Big Four firm has gotten a fine from FASB or AICPA for sharing answers on an ethics exam?
Yeah, and I wonder too if it's that like we live in that world, so we see it more often because like the AI is recording us and shooting us things from the accounting world because that's what we care about. I think that's part of it. And the other part too is just like it has to do with dollars, right? For businesses, It's going to get thrown out there and be elevated in press way more than a lot of other things.
That's fair. Last question, Jeremy. This principle requires that businesses align business expenses to the same period as the corresponding income.
Matching principle.
Yes, sir. You had that one ready to go. And the matching principle, Jeremy, you are correct. And the matching principle, would you like to just, explain why this is important to our listeners?
Yeah, like this is one that is very near and dear and that I hold our feet to the fire on pretty intently, is that you need to have the revenue and the costs that are associated with each other posted in the same period, right? So one of ours that we have on the nonprofit side is if they're throwing a fundraiser, right? And they have all these expenses for the fundraiser and dollars that maybe come in ahead of time based on this event. If that event doesn't happen, there's a chance that might all go away and they give the money back and maybe not have the expenses. So we put those as deferred revenue or prepaid expenses until we get to the month that the fundraiser happens. Then that all gets reflected there together. So you can run that month and look at all the fundraiser GL accounts and say, oh, here's what we made. Here's what the expense was. This is what really brought into the organization by doing this. So yeah, just lining everything up.
Jeremy, I'm tempted to give you one more bonus question just because I think it's my favorite one and I want to put it in there. But this principle determines whether a discrepancy, such as an omission or a misstatement of a number, would impact a reasonable user's decision making.
The materiality one?
Yes, Jeremy, the materiality principle. And I love this one because the amount of times I'll have a new employee come to me and like, hey, this cleanup we're doing for a client, I've got the $280,000 in the bank account reconciled, but there's an $8 transaction that I can't find and it doesn't match. How do I go about finding it? And I love to just say, it does not matter. It is $8. This is materially not going to change anything. The client needs financials, reconciliation discrepancy, and let's move on.
I agree with this one as well. So like I said, we get a lot of audits for our clients and they right away tell you need to look at and compare the balance sheet and the income statement year over year, and any material differences you got to provide comments on. And my first question always is, what's material for this audit? And then they give me a number and I'm like, all right, $10,000. So like, great, this is a big organization. I'm really worried about $10,000 things. And I'll bring that back to them when they ask these questions about little things. And I'm like, I don't feel this meets the threshold of materiality. Can we move on from this or do whatever you want to do? Right?
And most firms out there will argue that that materiality threshold is somewhere between 5 and 10%. So if 5 and 10% of a benchmark, usually that benchmark is net income. So if it's over 10% of net income, yes, it is very material, enough for a restatement of financials to investors, lenders, owners. Otherwise, if it's a mistiming thing and it's under 5%, just let it ride out the next month. Or, you've got options there.
My only caveat with this, too, is don't use this to be lazy either, right? Like, do your due diligence. We have that right to do for our clients the right thing, but just know that, like, hey, we've done everything we can. There's a super small dollar amount out there. Let's plug it and move on with the important things.
Yep. Jeremy, 4 out of 7. I'm proud of you. Way to go, sir.
Fantastic. I got one better than I thought I could.
Welcome to Fast Figures. 10 questions, 1 minute-ish. All answers are numbers. The game starts now.
And that's right. It is time for Fast Figures. Tyler, Otto, are you ready?
Bring it on.
All right. Little bit hint on the theme this week. A lot of things rolling over from 23 to 24 that could affect personal or business taxes. We've hinted at some of these, but I think it'd be good to have all these in one segment, along with some shenanigans focused around January. Let's get started.
I'm ready to start the year on a low note, so I can only build up from here. So let's see how it goes.
All right, let's do it. First one. So the standard deduction for those individuals who are married filing jointly was $27,700 in 2023. What is this figure in 2024?
It went up $750 a person, so that would be $29,200.
All right, the release date for this episode is January 4th. This is also Sir Isaac Newton's birthday.
Oh.
Within 50 years, what year was he born?
Oh no, 1835.
All right, contributions to a traditional IRA plan that are not taxable are limited to $6,500 in 2023. What is this limit in 2024?
Oh, I knew 65. 68.
Alaska became the 49th state of the Union on January 3rd of what year? The same year that Hawaii became the 50th state.
1926.
If you collect Social Security, this is the amount of cost of living adjustment as a percent you will get in 2024.
I feel like the IRS hosed them over. It's like 2%.
January 24th is known as Belly Laugh Day, and we all know that laughter is the best medicine. About how many facial muscles are used during laughter?
Just facial, so we're not counting the belly muscles.
Keep your sick back out of this.
My keg. 26.
26. All right. If you are submitting a tax return as a single filer and made $45,000 in 2023, you would have been in the 22% tax bracket. What percent bracket will you be in 2024?
18.
All right. January Jones, as you know, is a famous actress from Mad Men and X-Men First Class. What is her brassiere size?
I will proudly not get in trouble with my wife and even pretend I know this. 0.
The contributions to a normal 401k plan that are not taxable are limited to $22,500 in 2023. What is this amount in 2024?
24,000.
Last one. What percent of New Year's resolutions are kept?
Mine or most people in general?
Generally. And then I would love to hear yours too.
Well, I mean, you and I bring the average down. I'm going to go with 8%.
All right. Let's go back and take a look here. Standard deduction for those individuals married filing jointly was $27,700. You said $29,200. That is correct. Fantastic. The release date is January 4th. Sir Isaac Newton's birthday. You said he was born in 1835. Within 50 years? Nope, 1643.
Wow, I don't know history.
Now I know what to put in the questions. All right, IRA contributions limited to 6,500 in 2023. You said 6,800. It is 7,000. Alaska and Hawaii. What year did they become states of the Union? You said 1926.
Sounds about right.
1959.
Really?
Yeah. All right. If you collect Social Security, what cost of living adjustment are you going to get? You went with 2%. It is 3.2%. So probably still getting screwed a little bit, but not as bad as you'd think.
You know, I wanted to be the under because there's no way I wanted to pretend like those retirees are being taken care of. We know nothing in the tax code keeps up with inflation.
Yeah, and someday maybe they'll actually make some law changes with Social Security. Maybe. The amount of facial muscles being used during laughter, said 26. This number varied a little bit based on the source, but I found several of them that said 15.
Well, they're not doing it right because I use 26.
All right, you do, but you have such a beautiful face. Oh, all right. Next one. Single filer for taxes made $45,000. You were in the 22% tax bracket in 2023. For 2024, you said 18. It's the 12% tax bracket. Is there an 18% tax bracket?
Nope, I'm just dumb because Fast Figures puts a lot of pressure on you.
It does, man. Like I know. I'm not criticizing, but I didn't think there was. But I'm not the tax guy. January Jones's Brazier Sires. You don't have this memorized? I just love the January reference. Had to go with it. And you could have said waste or anything else, but why would I go there? I was so nice earlier in the episode. I had to go off the rails on one question. It's a 34C. Now you know.
Okay.
All right. Go back and watch those Mad Men reruns.
Can I just say, who does your IT? Because there is now a Google search for Jeremy looking for a brazier size of an address, of an actress. So whoever's doing your IT should have caught something there.
Hopefully I was using an incognito window so that like my sons don't type in a browser like January 5th. Like, wait, January 12th. What is this, Dad?
You're getting in trouble.
That's true. Second to last one. Normal 401k plan. The contributions, they're limited to $22,500 in 2023. What's the amount in 2024? You said $24,000. Not that generous, $23,000.
I'm not doing well here today.
No, I don't. Like last one. This one I'm going to give you. What percent of New Year's resolutions are kept? I saw a lot of 8 to 10%. I went with 9. You said 8%. I'm going to give you that one.
I'm taking it.
What is the Tyler Otto percent on resolutions kept?
Depends on the year. There was one year I lost like 35 pounds in a year. It was fantastic. And then another year I was going to, I gained all the weight back and was going to do it again, and I never did. So we're batting probably 25.
Yeah. I don't typically do resolutions, but try to make positive changes. And like some of them take, some of them do not. But it is what it is.
I was say, I don't know about you and positive changes if you decided to do this podcast, but thank you for coming along for the journey.
Yeah, absolutely. Well, I think if I look at these right, there was 3 or 4 maybe you got on this. So again, we are par for the course. Well done, sir.
And with that sound, our winner of the week, I don't know if you saw this, Jeremy, but late filing tax preparers got a big win this week. That's right. Nearly 5 million tax filers who have not submitted their 2020 and 2021 tax returns are getting penalty relief due to still post-COVID stuff. And starting 2024, those penalties will be reimposed. But if you hurry up and get everything filed, you can avoid any penalties those 5 million filers can, which that's generous for the IRS. Something tells me it's just they're so behind, they're just like, whatever, we can't get to it, we're just going to forgive them all. That's my guess. I mean, do you read anything else into this?
No, and I wonder how many people still have their head in the sand from those years when they just didn't do anything. And are they the type of people that see this or have somebody in their network that sees this and be like, hey, you might want to get on it now and let's do this so you don't have to pay these penalties because you won't have to right now.
Yeah.
But I agree with you. I think some of the IRS is like, well, this is a big backlog. We may want to just speed this along and make some joint win out of it.
And the thing is, this is 5 million filers. They're saying it's around 1 billion in penalty relief dollars. That's a chunk.
Oh yeah, absolutely. And we cannot balance a budget. Weird. Anyway, moving on to the loser of the week. So we're between the holidays when we're taping this, right? And like nobody wants downer stories and call out somebody's a loser. However, I did stumble on this story that there is a donut shop, and who here doesn't love donuts? Oh man, I have to anyway, a donut shop in Oakland that was robbed not once but twice in the past week. Oh, that's brutal. Like, first of all, just society doing this around the holidays, awful. But donuts, come on. That's like, it should be the national food. They're delicious.
I mean, but here's the question I have. I should probably go read the article. Did they just rob the till, or was like this someone that also robbed the baked goods? Because I want to know if I'm dealing with like just your average thug, or if this is Homer Simpson. Like,
oh yeah. And that's funny you brought that up, because I watched the newsreel and the video on it. And first of all, like, the owner wanted to be protected, so they didn't want to show her, but showed her shoes when she was talking, which I thought was weird. I said to my wife, is it weird that they're showing her shoes? And she's like, yeah, it's a little weird, but doesn't want to show her face. But she specifically pointed out, and they showed the video of the second ones taking the till, and while jumping back over it, reaching down for one donut and taking one donut with them. Because why not, right? Like, come on.
Yeah, burglary and a bear claw. I mean, who doesn't love that?
That's right. 2 at a time.
Well, Jeremy, before we call it for this week, I realized that there was one review on our podcast we had not gotten to yet. This comes from Kier1099 that said, literally, my favorite podcast. I'm not a big podcast listener, but I make sure I stay up to date on this one. I love games and trivia, and as someone in the accounting profession, this podcast is right up my alley. I play along at home or in the car, and I always learn a ton. The hosts keep me in stitches. So thank you, Kier1099. And if anyone else wants to leave a review, Apple Podcasts, or shoot us a message at unaccountable.co, we will happily read your message on our next episode.
Yeah, that's fantastic. Thank you. I feel like that's an epitaph. I want that on my gravestone. It's the best thing I think anybody said to me.
Well, for those of you that haven't yet, feel free to come join our Facebook group. There's shenanigans, games, and more coming down the pike there. Or feel free to leave us a message on unaccountable.co. And Jeremy, do I understand that you have a gift for our listeners for January?
I do. We have a gift. I think we're going to drop the second week of January a little tune that I compiled that I think those of us in the accounting world will find both humorous and entertaining at the same time.
Jeremy, as someone who has already listened to this, I did not know that you had some musical skills. So I'm quite impressed. But if you are looking for your theme song for January, look forward to our January 11th drop.
Yeah, we got you.
Well, Jeremy, until next time, keep being mediocre, and I hope you survive the first week of January.
You as well. We will talk soon.